Most traders enter too late, not because they're wrong about direction, but because they chase price. Professional traders do the opposite. They wait for pullbacks, let the market come to them, and enter with confirmation. In this video, you'll see how to trade pullbacks with structure, patience, and precision, the way the market is meant to be traded. Before we begin, here's a quick disclaimer. This content is for educational purposes only and reflects personal opinions, not financial advice. Trading involves risk, and you should always consult a licensed financial professional before making investment decisions. With that being said, let's get started. Let's start with the first pullback strategy, the break and retest. The break and retest strategy is a simple but powerful way to trade with clarity instead of emotion. Rather than chasing the market the moment price breaks a key level, you stay patient and wait for price to come back and confirm that level. This confirmation step helps you filter out false breakouts and gives you a much more structured and confident trade entry. Let me walk you through the process step by step. First, price clearly breaks above a well-defined resistance level. This tells you that buyers are starting to take control of the market. Instead of chasing that move, you stay patient and wait for price to pull back. When the market returns to that same level, you're watching to see if previous resistance now acts as support. If price respects that level and shows rejection, that confirmation gives you a logical and structured opportunity to enter a buy trade. Trading this way allows you to stay out of false breakouts that trap impatient traders, trade in the direction of momentum rather than fighting it, enter at a more favorable price with a clearly defined risk to reward. And of course, the exact same logic applies in the opposite direction when price breaks a support level during a downtrend. Before you can use the break and retest strategy correctly, you need to understand what's happening behind the scenes. When price breaks above a major resistance level, it's a clear sign that buyers are strong enough to push the market higher. Traders who position themselves early are now sitting in profit. But markets never move in a straight line. As price moves up, those early buyers begin locking in profits. That profit-taking creates temporary selling pressure, which causes price to pull back. This pullback is exactly where many traders make a mistake. They enter right after the breakout, assuming price will keep going up, only to get caught when the market retraces. Meanwhile, experienced participants, often referred to as smart money, are not chasing price. They're waiting patiently for a better entry, and the most logical place for them to step back in is the previous resistance level. If that level holds and price reacts positively, it confirms that resistance has flipped into support. That reaction tells you buyers are back in control. This is where the break and retest strategy truly shines. You're no longer guessing or chasing momentum, you're entering with confirmation, alignment, and structure. To trade the break and retest strategy correctly, your focus must be on confirmation, not the breakout itself. First, identify a clear key level where price has reacted multiple times in the past. Strong levels matter, weak levels tend to fail. In this example, we're working with a key support level. When price breaks that level, you do nothing. You don't chase the move, you wait. As price pulls back, you observe how it behaves around the broken level. Your goal is simple. Confirm that previous support is now acting as new resistance. If price rejects that level with clear price action, strong wicks, rejection candles, or momentum shifts, that's your confirmation. Only then do you enter the trade with a stop loss placed beyond the retest level for protection. The same logic applies when price breaks resistance. Wait for the retest, wait for rejection, then enter with confirmation. So far, we've looked at the break and retest in trending conditions. Now, let's see how this strategy works in a range-bound market. We've seen how the break and retest strategy works in a trending market. Now let's look at how to apply it in a range-bound market. In a range, price moves back and forth between support and resistance with no clear directional trend. This is where many traders get trapped by false breakouts. The rules here are simple. First, wait for price to clearly break the range, either above resistance or below support. Second, stay patient and let price pull back to the broken level. Third, enter only if price rejects that level, confirming that the breakout is being respected. The reason this confirmation is essential is simple. After a breakout, early traders often take profits, which causes price to pull back. If you enter too early, you risk getting caught in that retracement. The safest entry comes after the retest, when the broken level holds as support or resistance. That confirmation tells you the market is ready to continue in the breakout direction. Let's apply the break and retest strategy on a real example using the 5-minute chart. As you can see, the market is clearly trending higher, which tells us that buyers are in control. Price breaks above this resistance level with strong momentum, then starts to pull back. This is exactly the situation we're looking for, a break followed by a retracement. Instead of entering immediately, we stay patient and wait for price to return to the previous resistance, which is now acting as support. When price reaches that level, notice what happens. A clear-tailed bar forms, showing strong rejection and confirming that buyers are stepping back into the market. This is our entry signal. Because we're trading on the 5-minute time frame, we always check a higher time frame for confirmation. So let's move to the 30-minute chart. On the 30-minute time frame, price reacts strongly from this level and initially forms a support. When price returns to that level, it briefly breaks below it, then closes back above, creating a clear liquidity sweep. That rejection and reversal indicate that buyers are still in control and that the market is likely to continue higher, at least toward this supply zone. This higher timeframe reaction confirms our trade setup on the 5-minute chart. With higher timeframe confirmation in place, we go back to the 5-minute chart and execute the trade. The entry is taken after the rejection. The stop loss is placed below the signal candle or slightly lower to avoid being stopped out prematurely. The target is set at 2 times the risk. And as you can see, price moves exactly as expected and reaches the target. This is a textbook example of how the break and retest strategy works when you combine confirmation, patience, and multi-timeframe alignment. Now let's look at another example, this time in a downtrend. Right away, you can see that the market is trending down. This tells us that sellers are in control, so we're only interested in short trades. Here, price breaks below a key support level with strong bearish momentum. At this point, many traders jump in immediately, but that's not what we do. Instead, we stay patient and wait for price to pull back toward the broken support, which is now acting as resistance. As price reaches that level, something important happens. A bearish pin bar candle forms, completely swallowing the previous candle. This is a strong sign that sellers are stepping back in and rejecting higher prices. This pin bar pattern is our confirmation. It tells us the retest has failed and the downtrend is ready to continue. Because we're trading on the 15-minute chart, we quickly check the higher time frame. On the 1-hour chart, the market was ranging. Price then broke below the range, pulled back, and got rejected, forming a bearish pin bar. This indicates that the market is likely to move lower. With everything aligned, we return to the 5-minute chart and take the trade. Entry is taken after the pin bar candle closes. The stop loss is placed above the retest level, and the target is set at 2 times the risk. And now, watch what happens next. Price rolls over, momentum builds, and the market continues lower, hitting our target cleanly. This is exactly how you trade the break and retest strategy in a downtrend. Wait for the retest, wait for confirmation, then execute with confidence. Now let's look at a different environment, a range-bound market. As you can see, price is moving sideways, bouncing between support and resistance. There's no clear trend here, which is exactly where many traders lose money. At this point, price breaks above the range resistance. For a moment, it looks like a bullish breakout, and this is where most traders get excited and jump in. But instead of chasing the move, we stay patient. We wait for price to pull back and retest the top of the range, the same level that acted as resistance, which should now act as support. When price returns to that level, pay close attention to the reaction. Price gets rejected and forms a pin bar candlestick pattern, which tells us that the breakout is being respected. That rejection is our confirmation. Now let's zoom out to the higher time frame and make sure everything is aligned. On the higher time frame, the market makes a strong move downward, breaks below this support level, and then closes back above it. With higher time frame confirmation in place, we return to the 5-minute chart and execute the trade. The entry is taken after the retest and confirmation. The stop loss is placed below the retest level, and the target is set at 2 times the risk. And as you can see, once the retest holds, price expands higher and continues in the breakout direction. This example highlights a critical lesson. In a range-bound market, the breakout is not the entry, the retest is. Now let's move on to the second pullback trading strategy, which is the Trendline Bounce. A trend line is a simple tool that helps you visualize direction in a trending market. It's drawn by connecting swing highs or swing lows, and its purpose is not prediction, it's structure and guidance. Now that you understand what trend lines are, let's focus on how to draw them properly. When used correctly, trend lines can dramatically improve your market analysis. When used incorrectly, they can confuse you. A valid trend line requires at least 2 clear touches. The more times price reacts to it, the more relevant the trend line becomes. That said, more touches do not guarantee that price will respect it forever. A trend line is a tool, not a promise. Trends are rarely clean or smooth. Markets are often choppy and irregular. Sometimes price may briefly break a trend line, then close back above it. Other times it may spike through and immediately reverse. This doesn't mean the trend line is useless. It means you must read price behavior, not just the line. Trend lines should be treated as areas, not precise levels. Price will not always touch the trend line perfectly. Sometimes it will react slightly before reaching it, other times slightly after. What matters is the reaction, not the exact touch. When price retraces toward the trend line, shows rejection, and then continues in the trend direction, that's where high-quality opportunities appear. If a trend line is clear and obvious, draw it. If you have to force it to make sense, it doesn't belong on your chart. Ignoring key price swings just to fit a line is a common mistake. A forced trend line gives false confidence and leads to bad trades. The correct approach is simple. Follow the natural price structure, draw the trend line logically, and wait for the market to react. One of the most common questions traders ask is this: should a trend line be drawn through the wicks, the candle bodies, or both? The answer is simple. Draw your trend line where price reacts the most. Let me show you what that means. In this downtrend, notice how the trend line aligns with multiple swing points. Sometimes it connects wick highs, other times it lines up better with candle bodies. That's perfectly normal. The goal is not perfection, the goal is consistency. A good trend line is one that captures the maximum number of meaningful reactions, even if that means mixing wicks and bodies. If your trend line hits more key points, it carries more weight. Here's another example, this time using the lower trend line. We connect the swing lows using the exact same logic. The trend line is drawn where it captures the most meaningful reactions. That means it may touch wick lows, candle bodies, or a combination of both. Whatever gives the most consistent structure. The key is not precision, the key is context. So don't overthink it. Trend lines are tools meant to guide your analysis, not rigid rules that dictate every entry and exit. Now, let's move on to the Trendline Bounce strategy. The Trendline Bounce strategy is a trend-following approach. We're not trying to predict reversals, we're trading with the trend, using the trend line as dynamic support or resistance. Let's break it down using a real example, starting with an uptrend. First, we identify clear market direction. In this case, the market is trending higher, printing higher highs and higher lows. Buyers are in control. We draw a trend line below price by connecting the swing lows. The goal here is not precision, but structure. We want a visual guide for where pullbacks may find support. As expected, price pulls back toward the trend line, but instead of bouncing immediately, something interesting happens. Price briefly dips below the trend line, then closes strongly back above it. At the same moment, a bullish engulfing candle forms. This tells us buyers have stepped in aggressively. This is the key part most traders miss. That brief break below the trend line swept the stop losses of traders who bought too early. At the same time, breakout traders jumped in short, expecting a bearish continuation. The sharp reversal traps both sides. This is a liquidity sweep, and it often signals that the pullback is complete and the trend is ready to continue. Since the setup appears on the 5-minute chart, we zoom out to the higher time frame. On the hourly chart, price is reacting from a support area after sweeping sell-side liquidity. This tells us that higher time frame buyers are likely active, adding strong confluence to our setup. Now the lower time frame signal and the higher time frame context are aligned. With confirmation in place, execution becomes simple. Entry is taken at the close of the bullish engulfing candle. Stop loss is placed below the engulfing candle's low. Target is set at the next key resistance level, aiming for at least a 2-to-1 reward to risk. And as you can see, once price reacts from the trend line, momentum resumes in the direction of the trend. Now let's look at the same strategy, but this time in a downtrend. First, we identify market direction. Here the market is clearly trending lower, forming lower highs and lower lows, which tells us sellers are in control. We draw our trend line above price, connecting the swing highs. This gives us a clear structure and a zone where sellers are likely to defend the trend. As expected, price pulls back toward the trend line. When price reaches that area, it fails to push higher and gets strongly rejected. A bearish pin bar forms right at the trend line, signaling that sellers are stepping back into the market. This rejection tells a clear story. Buyers tried to push price higher, but they were immediately overpowered. The long upper wick shows rejection, while the close back lower confirms seller control. This is exactly what we want to see when trading a trendline bounce in a downtrend. Before entering, we zoom out to the higher time frame. On the hourly chart, the market previously moved higher, but formed a double top at resistance, a classic sign of exhaustion. Price also swept liquidity above that resistance, trapping late buyers. This higher time frame context tells us the downside move has strong backing and that sellers are likely targeting the next support level. With confirmation in place, execution is straightforward. Entry is taken at the close of the bearish pin bar, stop loss is placed above the wick of the rejection candle, target is set at the next key support level, aiming for at least a 2-to-1 reward to risk. And once again, price respects the trend line and continues lower, completing the setup. Trendline bounces work best when structure, price action, and higher time frame context are aligned. You're not guessing, you're reacting to clear market behavior. That's it for this video. We've covered 2 pullback trading strategies you can add to your trading plan and practice over time. As always, focus on patience, confirmation, and risk management. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell to stay updated with future lessons. Thank you for watching, and I'll see you in the next video.